Welcome back to the Deep Dive. This is the place where we take the strategic reports, the breaking news, and all the market forecasts, and really we just distill them into actionable knowledge for you. Now, before we jump into today's extraordinary material, I do want to mention that this deep dive is made possible by our trusted sponsor, Broker 360. So if you're in Argentina or maybe planning to travel there, Broker 360 manages all types of insurance policies. Auto, home, commercial, really, whatever you might need. You can find all their contact info, WhatsApp, website, and email right in the description below. A huge thank you to Broker 360 for supporting the show. All right, let's unpack this. Good morning. What a weekend the world just witnessed. The military extraction and capture of Nicolás Maduro on January 3rd, 2026, this Operation Absolute Resolve, it's not just a political shockwave, it's a definitive financial moment.
It's one of those generational events, really, and for you, the investor, the core question is just so clear. How does an event of this magnitude, where a major world power literally steps in and removes a leader, how does that influence U.S. and global energy markets?
Precisely. And that's why we are diving into a strategic global report that was prepared by a top macro strategy desk just this morning, January 6th. This isn't looking back. This is an immediate map of where capital is about to flow.
Right, and our mission today is to look past all the political drama and define this moment not as, a simple governmental transition. This is a structural inflection point for the entire Western Hemisphere's generated by the forced reconstruction of one of the world's largest and yet most deeply sub-capitalized resource markets.
Okay, so the report's core thesis is built around something they're calling the Trump Doctrine.
Yeah.
It says this whole event marks the beginning of a reconstruction capital investment supercycle.
A CapEx supercycle, yeah. And it's directed squarely by the U.S. government. That security guarantee is really the linchpin of the entire investment thesis.
Right, the Pottery Barn rule they mentioned.
Exactly. If you break it, you pay for it. Or in this case, you fix it. The administration's stated policy is that they will temporarily administer Venezuelan resources to finance the recovery and to compensate U.S. interests, of course.
But, we've seen major strategic pivots before. What makes this guarantee credible this time? Given the history of risk in these markets.
The credibility comes from two places. First, the strategic necessity, and second, the financial mechanics. The explicit declaration that U.S. oil companies will spend billions, and fix the rotten infrastructure, that is incredibly powerful.
So it's a de facto sovereign security guarantee.
That's the term. By basically naming who goes in, Washington is absorbing the political risk. That just crushes the country risk premium for those selected firms. It's state-backed industrial policy.
And if the U.S. is guaranteeing the capital, where does that leave our geopolitical competitors? I'm thinking of China and Russia, who are owed, over $13 billion combined?
Yeah. Well, that's the strategic imperative, isn't it? Washington is moving to deny them control over the world's largest proven oil reserves. We're talking about 303 billion barrels.
So it secures the asset, but also secures the supply chain.
Exactly. It's an operational goal, too. You secure a close, reliable source of heavy crude specifically for the U.S. Gulf of Mexico refining complex.
We're talking about PED3. That's where all the big complex U.S. refineries are.
That's right. PED3 is vital. Think about it. A quick 4 or 5 day tanker trip from Venezuela is just so much better than relying on long, risky 30-day trips from the Middle East.
It's a no-brainer from a logistics perspective.
Totally. It's a supply chain stability issue.
Okay, so let's get into the infrastructure itself. A lot of people are drawing parallels to Iraq in 2003, but the report points out a really fundamental difference.
A huge difference, and it dictates where the money flows first. Unlike Iraq, which suffered, kinetic damage from war, Venezuela is suffering from atrophy by negligence.
Atrophy by negligence. So the infrastructure wasn't bombed, it was just starved.
Starved of maintenance capital for 2 decades. The fields and the pipelines, they aren't destroyed by bombs. They're corroded, they're burned out, and they've been improperly shut in for years.
And the implication for investment there is massive. It means the initial spending isn't for, say, high-risk exploration.
Not at all. It's for basic remediation.
What does that actually look like on the ground?
Remediation means immediate, smaller scale, but very high-return fixes. Think about things called workover issues.
Okay.
So reactivating wells that were improperly sealed, replacing corroded pipelines on the surface, restoring the power grid that feeds the oil fields. It's a maintenance and recovery trade first.
Which favors the specialized service companies who can get in there fast.
Exactly. Not the pure exploration plays that need massive long-term permits and years of work.
Right. That brings us to the scale of the problem. The report's second section deals with this astronomical number, this $183 billion gap. Production collapsed from over 3 million barrels a day to less than 1 million.
And the cost of that collapse is all in the Rystad Energy data they cite. To get production back to 3 million barrels per day by 2040, it requires a cumulative capital injection of $183 billion.
An unprecedented financing need. And with PDVSA technically bankrupt, that capital has to come from the international majors, the IOCs.
From the IOCs and from U.S.-backed aid funds. And that completely shifts the negotiating power, doesn't it?
It has to.
The U.S. security guarantee and the urgent need for cash mean companies like Chevron can now demand much more favorable terms. They will not tolerate the restrictive joint ventures of the past.
Where PDVSA controlled the majority stake.
And all the operational decisions, that's gone.
So they'll be demanding production sharing agreements or PSAs instead.
Yeah.
How do those work?
PSAs are just crucial for you as an investor to understand. They allow the oil companies to take a much larger, often majority share of the actual oil that's produced.
Until their capital's paid back.
Until it's fully recovered. And this gives the majors both higher financial returns and, critically, greater operational control. It protects that $183 billion investment.
Let's talk about the global price impact. The report points out a dichotomy here that is really important to grasp. Goldman Sachs forecasts for 2026 are stable, right? Around $56 for Brent. But the long-term outlook for the commodity price itself is a little bearish.
That's the trade-off. It's a great point. If Venezuela successfully gets 2 million barrels a day back online by 2030, that extra volume could subtract, say, $4 from the long-term price of a barrel.
Which is bad news for U.S. shale producers.
Yeah.
They're pure commodity price plays.
They do not want cheaper, heavy crude competition, no.
But for the investors focused on this reconstruction, that volume is actually a positive sign.
It's highly positive for the volume of services. I mean, the capital spending, that CapEx supercycle, it has to happen regardless of whether Brent is $56 or $52. The U.S. government is guaranteeing the activity.
So the oil field service companies and the refiners, they're insulated from the short-term price swings.
That's the key takeaway. It's a volume play, not a price play.
So if the macro picture is all about this guaranteed CapEx, let's follow the money. Where does that capital flow first? Starting with the big upstream players.
You have to start with Chevron, CVX. They are the report's top pick, and more importantly, they are the de facto sovereign operator.
Because they never left.
They never left. They maintained an operational presence under General License 41 right through the sanctions.
Which means no negotiation for re-entry. They can deploy immediately. What does that mean financially?
It means immediate capital deployment into their existing joint ventures like Petropir and Petroboscan. They're already producing around 200,000 barrels a day.
So the money goes straight to quick, high-return repairs, no delays.
Exactly. And you have to remember, their own U.S. Gulf Coast refineries, like the one in Pascagoula, are perfectly set up to process this heavy crude. They capture the entire margin.
Okay, so that's the incumbent. What about the others? ConocoPhillips and ExxonMobil. The report calls this the litigation thesis.
Right. Their entry point isn't about current production, it's about debt recovery. ConocoPhillips is holding over $10 billion in recognized arbitration awards.
And the new government will likely formalize oil for debt deals to settle those judgments.
It's highly probable it's the fastest way to clean up the books. So holding COP stock, in effect, becomes a kind of call option on Venezuelan solvency recovery. It's an asset play tied to the legal cleanup.
Okay, moving down the chain to oil field services, the OFS companies. You call them the architects of the repair.
They are the engine of this CapEx supercycle. If Chevron is the anchor, these are the companies doing the work.
And the report highlights Halliburton, HAL, as the executor. Why is their timing so crucial here?
Because the immediate need is for workovers. It's not about building new stuff.
Right, the remediation.
Workovers mean getting in there fast to fix fundamental failures, unclogging wells, replacing burned-out pumps, things like that. Halliburton can do that kind of work in a matter of weeks once payment is secured.
A short-term timeline advantage.
A huge one. Then you have SLB, which used to be Schlumberger. They bring the advanced tech.
Reservoir characterization, that kind of thing.
Exactly. If the goal is speed, the new government will probably use integrated service contracts managed by SLB to quickly figure out how to optimize these huge, mature fields.
And what about Fluor Corp, FLR, the big constructor?
Fluor's expertise is engineering and construction. They've been in Venezuela since 1944. They're the ones you call for the massive structural repairs on the surface infrastructure, pipelines, export terminals, processing plants.
And they know how to work under U.S. government contracts.
Perfectly positioned for any publicly funded reconstruction tenders.
Okay, if you're finding this breakdown useful, we'd just like to invite you to subscribe, leave a like, and maybe comment on what other topics you'd like us to dive into next. Also, you'll find links in the description to our sponsor, Broker360, and also a PayPal donation link if you'd like to support this project. Honestly, even the cost of a coffee helps us continue this research, so thank you for your support. Now let's shift downstream to Section 4. The report calls it the logistical bonanza. This is about the U.S. refiners.
This is a direct financial benefit that is already being priced into these stocks. As we said, the Gulf Coast refineries and PD3 are optimized for heavy, high-sulfur crude like Venezuela's Marais 16.
And the short transit time alone cuts down on working capital costs.
Massively. Crude is in transit for days, not months.
And that, combined with the increased supply, directly impacts the crack spread. Can you just quickly explain that term for our audience?
Sure. The crack spread is simply the margin, the profit a refiner makes by cracking crude oil into usable products, gasoline, diesel, jet fuel. When your input cost, in this case heavy crude, is discounted because of a reliable new supply, the margin between that cheap input and the high price of the refined product just expands.
And that margin expansion is pure profit.
Pure profit for complex refiners. The key plays identified here are Valero, VLO, and PBF Energy.
Valero is the big one.
VLO is best positioned because of its sheer scale and technical complexity. They can just handle this stuff better than most. PBF is cited as the higher beta play.
Meaning more sensitive to these changes.
Exactly. More sensitive to the heavy crude differential, so their earnings should expand disproportionately if that discount widens fast.
All right, now for the highest risk area, the debt minefield. The battle for Citgo. This sounds like high risk, high reward.
And massive legal uncertainty. This is the political powder keg. A federal judge just approved a bid from Amber Energy, that's an Elliott Management affiliate, for $5.9 billion for Citgo.
But the asset is fundamentally worth much more, $11 to $13 billion.
Right. And now the Trump administration may try to halt the sale, citing national security, to preserve Citgo for the new Venezuelan government.
So you have the administration versus the U.S. courts versus major hedge funds.
It's immediate legal chaos for anyone holding Venezuelan debt.
So for investors looking at that massive $160 billion debt stack, understanding the hierarchy of who gets paid first is critical.
It's everything. Top of the list, top priority are the PDVSA 2020 bonds. This is the key distinction.
Why them?
Because they are secured by 50.1% of Citgo shares. Think of it like they hold the mortgage on the asset. That gives them immediate leverage and priority recovery.
And below them.
Next up are the arbitral awards. The ones held by companies like ConocoPhillips. These are backed by legal decree from the courts.
And at the very bottom of the pile
are the unsecured sovereign and PDVSA bonds. These are essentially just IOUs backed by hope. They're going to rely on a slow, politically charged national debt restructuring that will probably last 5 to 10 years.
Especially since Washington has to deal with the debt owed to Beijing and Moscow.
A huge complication.
We have to close with the risks. An event like this is inherently risky. What are the key structural risks to this whole CapEx supercycle thesis?
The report highlights what it calls the Iraqization risk. Capturing the top leadership does not guarantee pacification.
You still have armed non-state groups.
The collectivos, FARC, ELN, they could easily pivot to asymmetric insurgency, specifically targeting and sabotaging energy infrastructure.
And if they hit a major pipeline?
It could instantly freeze the flow of U.S. capital. Nobody wants to invest in that environment.
And the legal mess around Citgo has to complicate any long-term planning.
Oh, absolutely. The transition needs a stable, market-friendly hydrocarbons law. If internal disputes in the new government, plus the Citgo battle, delay that legal framework, the long-term capital will just wait on the sidelines.
So bringing it all together, what's the final portfolio strategy for investors looking to capture this opportunity in the coming months?
Short term, say the next 6 to 12 months, the strategy's pretty clear. Overweight the service companies like HAL and the complex refiners like VLO.
Because that captures the immediate guaranteed spending.
And the widening crack spread without taking on all the commodity price risk for a long-term anchor.
You stay with the incumbents.
You maintain strong positions in Chevron, CVX. They hold the keys to the kingdom. And unless you have the institutional capacity for these high-stakes, decade-long plays, avoid the unsecured sovereign debt entirely. Look, the forced reconstruction of Venezuela, triggered by this operation, has clearly defined the direction of capital. It's all flowing towards the rehabilitation of the largest underutilized oil asset in the Western Hemisphere. The ultimate test is going to be whether Washington's political will and this massive capital injection can overcome the very real risks of insurgency and legal chaos. That is what will determine if this is a true generational investment opportunity.
A phenomenal and highly actionable deep dive into what is a critical and still developing situation. Thank you for walking us through this strategic report. And with that, we come to the end of today's deep dive. We really hope you found this insightful and that you learned something new. And remember, in the description of this episode, you will find links to our sponsor, Broker360, and to PayPal if you'd like to support us. Thanks once again. We hope you join us next time.